Hello, everyone, and welcome to our Understanding Your Credit webinar presented by Signal Financial Federal Credit Union. My name is Saeed Halim, and I'm the VP for Real Estate and Consumer Lending here at Signal Financial. I'm joined by Alice Yang.
Hi, my name is Alice Yang. I'm the Manager of Mortgage Origination and Loan Servicing here at Signal Financial Federal Credit Union.
Thank you for joining me today, Alice.
Happy to.
All right, so let's go into our agenda for our webinar. So first off, we'll talk about what a credit score is. Then we'll move into the role of a credit score. After that, we'll break down how a credit score is determined, and we'll walk through different tools and tips to help understand your credit report. And lastly, we'll close out with some tips to improve and maintain your credit. So to start us off, I wanted to talk a little bit about what a credit score is. So generally speaking, a credit score is a numerical measure of your credit worthiness. So what that means to potential lenders is it represents the likelihood that you'll repay what you borrow from that lender. And ranges of a credit score are typically 300 to 850. Now let's go ahead and break down what the different credit scores mean. So what you see here is a chart for the different credit scores found across the U.S. consumer population. Of course, each lender is going to have their own credit tiers and their own breakdown of what they consider exceptional, very good, good, fair, and poor credit. But this is a pretty generally accepted one, so we're just going to use this one for illustration. So a credit score of 800 or more is considered exceptional. It's well above the U.S. average score for U.S. consumers, and it demonstrates to lenders that this person with this credit score is an exceptional borrower. A credit score range of 740 to 799 is considered very good. Again, it's above the average for U.S. consumers, and it also demonstrates to lenders that this borrower is a very dependable one. A score of 760 to 739 is considered good. It's near or slightly above the average for consumers, and most lenders will consider this to be a good credit score. The range of 580 to 669 is considered fair. It is below the average score for U.S. consumers. However, there are plenty of lenders out there that will approve loans that fall within this score range. And it all depends on what the product is that you're applying for. And what will also happen is, a credit score in this range will also have an impact on the rate. And Alice will go into it in a little bit, the different, the impacts that are out there that relate to your credit score as far as interest rate and your terms. And finally, for a score of 580 or below, that is considered a poor credit score. And it's well below the average, and it demonstrates to lenders that someone with this low of a credit score may be a risky borrower. So Alice is going to talk to us about the role of a credit score.
Okay, thank you, Sam. So the role of the credit score. The credit score is one element of the loan decision-making process. There's other various elements in the loan decision making process, such as ratio and also employment and other elements. But credit score does play a main element in the loan decision-making process. Often it is the key to a better rates, like Saeed mentioned earlier, with the different tiers. It also, the higher your credit score is, the higher limits that you'll be able to have on different credit revolving credits. And also you get more favorable loan terms in general. There's more various different loan terms that is available to you as a consumer if your credit score is higher. It also improves, streamline, and ensures fairness in the lending process. So it eliminates any unrelated judgment that is made in the loan decisioning process. And why should you care about your score? Your score actually plays a big role in your everyday life, such as ability to borrow, cost to borrow, loan terms, ability to earn rewards and points for credit usage, and this is mostly targeting your credit cards mostly. They offer a lot of credit cards nowadays offer rewards and points, and the higher the credit score, you'll be able to have higher rewards because of that. Ability to rent, especially nowadays, rental office, and also personal renters, they actually do a soft inquiry, which Saeed will talk about later, on your credit to see your trustworthiness so they can be more available to rent to you. Utility is cell phone service. Different cell phone carriers, they use your credit score. Auto and homeowners insurance company, they also pull soft inquiries on your credit to see your trustworthiness. Also different various employers, they do soft inquiries on your credit to, again, see your trustworthiness, especially financial institutions. They do that. So now we look at the credit score impact on interest rates. So here we have an example of $18,000 auto loan on a term of 72 months. And it shows you the different rates that you'll get depending on the different tiers of your credit and the monthly payments and at the end, the total cost of the loan. So we're just going to take two different tiers. One is excellent and poor, and one is poor on the bottom, and compare these two to see the difference in costs and to you. So with excellent credit, in this example, you get a rate of 2.77% with a monthly payment of $271.64, and a total cost of the loan at the end of the 72-month term is going to be about $19,557.93. And we compare that with a poor credit tier, which interest rate is going to be about 13.72%. That's a high interest rate. And then with a monthly payment of $368.21, and the total cost of the loan at the 72-month term at the end is going to be about $26,511.12. That's almost $7,000 in difference compared to excellent credits tier that you'll have, which is a lot of money out of your pocket if you were to have excellent credit.
Yep. Thank you for sharing this, Alice. I think it's a very powerful message, and it really speaks to the importance of trying to maintain a higher credit score, because you'll end up with better and more favorable loan terms, such as a lower interest rate, because it'll give you a lower monthly payment as well as save you money over the life of the loan. So, very, very, very important to keep in mind the, how important it is to keep a higher credit score.
Definitely.
All right, so now I'll talk a little bit about how a credit score is determined. So there are 5 key ingredients that make up your credit score, and they are payment history, amount of debt, length of credit history, new credit, and credit mix. And I'll go into some detail about each of those components. So payment history makes up 35% of how a credit score is determined, and what that looks at is on-time payments and the types of accounts that are being paid. Late payments, so how late payments are, the severity of the late payment, the frequency, the amount, and how recent. Payment history also takes into account any bankruptcies, judgments, and collections. What you'll also notice we included on here are statistics about individuals with the highest credit scores. So typically, individuals with the highest credit scores have no missed payments or collection items, and that makes up 96% of individuals with the highest credit scores. So can't stress enough how important it is to be mindful of payment history and try as much as possible not to miss any payments, because that's the biggest factor in determining a credit score. Next, we'll talk about the amount owed, which makes up 30% of a credit score. And so what that factors is the remaining amount owed on installment loans. It looks at the credit utilization ratio, and what that is the credit utilization ratio. What it calculates is the total amount of revolving line balances that have been drawn compared to the total available balance. So if you think about your credit cards, The more that you have borrowed and drawn on your credit cards, the higher your credit utilization ratio will be, and that could potentially have a negative impact on your score. The other thing that's looked at with amount owed is the number of accounts that you have outstanding with a balance. And again, that statistic about the individuals with the highest credit scores, they typically have less than 6% revolving credit utilization and less than $3,000 in revolving balances. So again, it's important to keep in mind, the significance of keeping your credit card balances in check and not letting the credit utilization go too high, because that can have a negative impact on credit score. The next factor we'll talk about is the length of credit history, which makes up 15%. So a longer credit history improves your score. So that's why it's really important to hold on to your oldest account, because the age of your oldest account is factored here, as well as hold on to as many old accounts as you can, because there's also an average component here. So individuals with the highest credit scores typically have an average age of 11 years or more for their accounts, and their oldest account is 25 years old on average. So think back to that first credit card that you had or the line of credit. You want to make sure, if you can, keep that open, because that impacts the age of your oldest account and impacts the overall average age of your accounts. Next, we'll talk about new credit. So what that looks at is any new accounts that have been opened or any new inquiries in the past 2 years. And typically, individuals with the highest credit scores open their most recent account within average of 2 years and 5 months ago, and less than 35% of them applied for new credit once or more in the past year. So basically what that means here is really be mindful of how often hard inquiries are performed. So what that is try to limit the number of times you apply for a loan. And lastly, we'll talk about credit mix. So what this is it factors the blend of the loan types that you have. So think car loans, home loans, credit cards, installment loans. The better and more diverse the blend is, the better it is for your credit history. So now I'll turn it over to Alice to talk about the credit report itself.
Okay, I'm going to talk about the credit report. So there is a website that you can access a copy of a free credit report of your credit report annually, and it's annualcreditreport.com. It is government mandated. It has great tools on there. It's a credit report that you can pull annually just to review everything and make sure everything is correct. The 3 different bureaus that is in your credit report is Experian, TransUnion, and Equifax. And if you do see an error on your credit report, please go ahead and contact them as soon as possible so they can make adjustments or contact your lender, which Saeed will go ahead and get into later. So it is annualcreditreport.com. You can access your credit report, and we do recommend that you do that every year, just to make sure that you keep track of everything and all the transactions that's on it. So other ways to review your credit for free. There is some credit card features, free credit checks as a courtesy service. Credit card companies, they do offer that for free. They offer your credit score for free. Also Credit Karma and NerdWallet, also a free service that is available to you with different tools that you can use. Some financial institutions offers their own complimentary credit monitoring service, even for non-customers. So it's a great way to monitor your credit, to make sure there is no unnecessary pulling of your credit. So it's a great tool to use, and so you can go ahead and make sure your credit is in a good standing.
Very good.
Yeah. And Saeed is going to talk about the different types of inquiries.
All right, so I'll start off with talking about a hard inquiry. So a hard inquiry is typically a result of an application for credit. So this type of inquiry can represent additional debt that doesn't appear as an account on your credit report. So when lenders see a hard inquiry on your credit history, they may look at this as potentially risky behavior. They also look at it to further inquire to see, okay, from this hard inquiry that we see, was there new debt that was taken? And so recent new debt, as we talked about earlier in the different components that make up credit score, can be an indicator of risk if someone is going out and doing a lot of hard inquiries and taking on a lot of new loans. The other thing to keep in mind is every hard inquiry is bound to have some type of impact on credit score. So you really want to limit the number of times that a hard inquiry is performed on your credit report. On the flip side, a soft inquiry does not affect lending decisions or your credit score. And when potential lenders pull your credit, they don't see these soft inquiries. And so a soft inquiry is usually a result of a consumer getting a copy of their own credit report, purchasing a credit score or a credit report. It's also done when potential lenders do a pre-approval offer. So a lot of you may have received in the mail a pre-approval offer for a credit card or for a car loan. And what that means is the lender may have done a soft inquiry on your credit in order to find out who may potentially qualify for that loan or for that credit card, and they can use that for marketing purposes. All of that doesn't impact your credit score. It doesn't reduce it in any way. As Alice had mentioned earlier, insurance companies and employers may do soft inquiries to take a look at your credit history, as well as your existing lenders. So if a lender has a revolving line of credit outstanding for you, they may do a periodic review of your credit history to ensure that you're still in good standing and make sure that the borrower is treating their credit as they should. Because sometimes a lender may decide they want to increase your credit limit if your credit has improved or if you've shown a history of, positive trend on your credit report. Or on the flip side, if a existing borrower shows risky behavior or maybe they're not making payments, they may use that that soft inquiry to reduce a credit limit or even close it in some instances. And as far as how long events remain on your credit report, hard inquiries will stay on your credit history for 2 years and remain visible for those 2 years. Late payments, accounts in collections, judgments, and Chapter 13 bankruptcy will remain on your credit report for 7 years. And finally, Chapter 7 bankruptcy will remain on your credit report for 10 years. And Alice is going to talk to us about improving your credit.
Okay. And I'm going to talk about how to go ahead and improve your credit. Rebuilding your credit, it can be challenging. It's not an easy task. So please take your time, one step at a time, to improve your credit. And there's a lot of tools out there to help you do that. So definitely do your research. Step one is to review your credit report. Like I said earlier, that go ahead and get your credit report annually to dispute any errors in writing to the agency reporting them, the 3 different bureaus that I mentioned earlier. Discuss any potential discrepancy with the lender. Work with lenders, send them notices to make sure that they have all the information correct and correctly reported on your credit. That would ensure that your credit score is definitely correct. Keep copy of correspondence that you have with the agency reporting them, and as well as with lenders in regards to disputes or anything in that case. And step 2, create a plan to repay your debts. Make payments on time. Like Saeed mentioned earlier, it plays a big role in your credit history and your credit scoring. Your credit history, such as lateness, it does have a really big negative impact on your credit. Even if you only can make the minimum payment, go ahead and do that instead of missing a payment, which has a big negative impact on your credit score. Talk to your lenders, because a lot of lenders, they want to work with you to arrange, to make sure that you those payments. Arrangements can be made sometimes, no matter how it is. Either is go ahead and extending the term of the loan so it can lower your payments, or it can go ahead and make payments holds on your account, so to give you that time to breathe so you can go ahead and make the payments later. So it definitely, lenders does look at hardship requests. Each lender is different, the process different, but each lender do want you to make those payments and they do want to work with you. So please feel free to contact them if you need help. And also look at interest rate on the outstanding debts. Definitely go ahead and target those highest interest rates first. So it would definitely save you some money at the end. Like we looked at earlier, the total cost of the loan, it definitely go ahead and lowers that in general. And step 3, we'll go ahead and look at considering loan product intended to rebuild your credits. So if you do have poor credit and or credit score that is not that is lower than average, there are ways to go ahead and rebuild them, which is such as secured credit cards or secure loans, credit builder type loans. Ensure that these type of loans are reported to the credit bureau, so it does have a positive impact on your credit, because there are some loans out there that is not reported, and those are not going to help you to improve your credit. So definitely make sure you talk to a lender, ask all the questions you need to ask, and that would definitely significantly help you improve your credit.
Very good. So Alice talked to us about the different steps to help improve your credit. I wanted to share a little bit about Signal's resources page. So if you go to the Signal Financial website and hover over services, you'll find a link for Signal resources, and you'll see different online classes and tools that we have that are available at your disposal. And one of the ones I wanted to call out was Balance. So this is a financial fitness tool that we recently signed a partnership with, so we can offer our members access to the different balance tools for free. And within there's a lot of different financial guidance resources. Some of them are for credit history and improving your credit. Some of them are for budgeting. So we highly encourage everybody to visit the website and see what we've brought on for our members to explore and take advantage of for the benefit of their credit. That being said, we wanted to thank you for your time and thank you for listening to us today. We really appreciate it.
Thank you, everyone. Have a great day. Stay safe.
All right. Thank you, Alice. Thanks, everyone. Bye-bye.
Thank you. Bye.